Thank you everyone for joining us today. It's certainly been a strange time for many of us, both professionally and personally. So I first hope that all of you joining here today and your families are staying safe. So today's webinar is aimed at helping staffing companies navigate this COVID-19 crisis. I'm sure that many of you have been following the recently passed legislation aimed at helping small and mid-sized businesses. But the problem that we found has been the implementation guidance has lagged behind, and as a result, there's a lot of misinformation out there. So, this is still a very fluid situation, but hopefully we can provide you with an update of where things stand and just an overview of kind of what we've seen through clients and our contacts throughout this process. We also wanted to tailor this presentation specifically for staffing companies and incorporate some discussion of other issues that staffing companies have been facing during this crisis, and hopefully offer some solutions to address these issues. My name is Michael Zaborovich, and I am joined today by BJ Hoffman and Mike Napolitano. We are partners at Citrin-Koopman & Company. Citrin-Koopman & Company is a full-service CPA firm, regional firm. We are also the co-leaders of the Citrin-Koopman staffing industry practice, and as a firm, we service to provide accounting, tax, and consulting services to more staffing companies throughout the country than any other firm. We first want to start by focusing on cash management. And the reason is that understanding your current cash situation and having an accurate cash forecast, I think, is vital when making or when trying to make informed decisions about some of the legislative and lending options that we will be covering in this presentation. So when we talk about cash forecasting, at the heart of it, I think, is a 13-week cash flow. And essentially what we talk about is a forecast of cash inflows and outflows for a running 13-week period. Again, when I say running, you would continually update it to give yourself a view of both a short-term and long-term. When I say long-term, these days 3 months is long-term. But essentially it will show you how long will your liquidity last, and it will certainly address what is your runway for the next week, month, or quarter. So when doing this forecast, and analyzing your cash inflows and outflows, let's take a look at inflows first. So you talk about accounts receivable, collections, and borrowing. Borrowing we're going to address below. But when you take a look at accounts receivable collections, a couple of things to factor. One, anticipate slower cash payments. It's just the environment that we're in, and so undoubtedly you will have a lag as compared to where you normally might be. Talk to your clients about their payment cycles. Talk to them how they're doing. Take a look at your aging and identify clients that might be significantly affected by this crisis, and factor that into your analysis. When you look at cash outflows, bifurcated by what's fixed, the fixed costs being rent, utilities, payroll, and then variable, commissions to salespeople, advertising. And then kind of break that down further into, hey, here's things that I must pay, here's things that I like to pay, and here's payments that I can defer. And so we'll talk about this later, but certainly, our clients, have had success reaching out to their landlords and negotiating a deferral of payment. There's certainly a time to do that now, and I think landlords are open to it. Perhaps even using your security deposit as a month's payment. So something to factor in there as well. And then when we talk about forecasting is essentially, the most likeliest of outcome. When we look at, the different looking at different scenarios, then you're talking about projections and projecting out various scenarios and stress testing them, I think is important, especially when you're looking at borrowing options and staff levels. So you want to kind of break it out. If I get this loan, if I collect this money, you know, what are the staff levels? And ultimately, I think that's a huge decision for staffing companies. So let's move on to borrowing options and talk about that. So when you look at, you know, your historical sources of liquidity, what are they? We talked about AR collections. You might have some related parties. You might have, you know, personal contributions that you've dealt with before. And at the heart of it, especially for staffing companies, bank lending is often, you know, the lifeline, right? So taking a look at those sources and which ones are still valid. When we look at lending, asset-based lending is a form of lending that's generally used by staffing companies, and it relies on a borrowing base, and that is often the eligible borrowing basis is obviously based on allowable receivables. So one of the things that we've instructed our clients, and we've talked to lenders about this, is expanding your borrowing base by extending the definition of allowable receivables, right? So generally anything over 90 days is allowable, seeing if you can push that maybe to 120, maybe your national clients push that past 120. Anything to give you some breathing room and maintaining a strong borrowing base, right? Taking a look at, you know, what additional credit options are there? Can you extend an existing line? Can you get a term loan? You know, in talking to lenders, I think banks are still willing to lend to companies with strong fundamentals. We'll talk about certainly government funding options and some of the loans out there, but I think the key is, to the extent that you can get access to available credit, do it. Even if you think right now you don't need it, you don't know how long this is going to take, you don't know the effect on your, you know, or have a full understanding yet on the effect on cash receipts. And so to the extent that you can have access or you can get access to available credit, I think we recommend to take it. So let's look at staffing levels. Obviously, most significant outflow. And this is a difficult topic because ultimately there are no easy choices when determining, you know, optimal staffing levels in this type of crisis, right? So it's often a delicate balance. You know, when you do this and, you know, a cash forecast, it helps, you know, guide you as to what choices you might need to make. And as you try to stabilize your cash flows, you want to be, you know, make quick decisions. But at the same time, cutting too fast, cutting too deep can certainly be harmful. So again, a delicate balance. When you talk about cutting staff levels, one, I'm going to call it an opportunity, but if you had historically low performers even before the crisis, I think maybe you start there. It will give you an ability to stabilize your overhead, and then move on to, you know, sales, recruiting, admin support staff. But again, figuring out what your cash forecast is will give you a general outline of how deep you would need to cut without, you know, going too deep. And there's also some strategies, you know, to manage staff levels to hopefully avoid, you know, cutting staff levels. So one of the things is cutting the base salaries of internal staff. I think that's a rather obvious one. But with that also comes, you know, senior lender, the senior leaders, I think, should also, you know, share in some of the burden. And what that does is I think it helps build the team culture, that you're not pushing it all down to internal or you know, cutting internal staff. Deferral of payments for commissions to sales staff is a strategy that has been used. And then if you have a company that has multiple verticals, here's something to consider. If you have, you know, moving temp staff from a heavily effective business line to one that might be thriving. So if your business includes a hospitality vertical, which is obviously hurting in this time, then I think, you know, consider maybe moving to warehouse or logistics, which are two verticals that might be thriving. So and as we get through the legislation, you're going to see that there are considerations for employment levels for how many employees you have at the time. So another consideration is as we talk about the legislation, the loans, factor in the levels when you're making these decisions too. So next we're going to cover, I think, two significant programs that were passed, the Families First Act and the CARES Act. And in it, we're going to talk about specific provisions and give you an overview and talk about how to implement them. So I'm going to pass it over to BJ, who is going to cover the Family First Act, which was one of the first legislative pieces that was passed during this crisis.
Hey, thanks, Mike. The Families First Coronavirus Response Act, also known as the FFCRA, was passed like what we feel like is eons ago now, March 18th of 2020. The act is effective at the beginning of April and carries on through the end of 2020. The act applies to companies with fewer than 500 employees, and that employee headcount is a broad headcount. It includes temps, it includes your internal employees, and it also includes affiliated companies. So what does the FFCRA do, or where are we going to focus our time on, is the creation of a mandatory sick leave and the expansion of the Family Medical Leave Act, which, when this was legislated, all of our clients were up in arms thinking that this is an additional new government mandate, that companies were going to be compelled to pay their workforce sick time and expanded family medical leave time, and that at the very least, even if the government were going to be refunding and paying for some of this, would be an incredible tax and cash flow burden on companies. Well, it turns out that when all is said and done, that this is far less onerous than was originally thought. But what we need to do is talk about the specifics and then indicate why that burden isn't as great as was initially thought. So let's talk about sick leave. Mandatory sick leave is for any employee that's with you at the time that the act was enacted, which was at the beginning of April. The sick leave component is 10 days. So you as the employer are compelled to pay employees for up to 2 weeks or 10 days of sick leave if they fall into any one of 6 categories. Depending on which of the 6 categories the sick employee falls into will drive the amount of the payment that you need to pay them. So the first 3 categories, which I'll mention now, an employee who is subject to a specific quarantine or isolation order, or an employee who has been advised by a doctor to self-quarantine, or any employee who's experiencing corona-like symptoms, will be compensated by you up to 10 days or 2 weeks. The amount of that compensation will be the lower of their actual wages, or $511 a day. And where you have part-time labor or temporary employees involved in the sick pay, it will be based on the average number of hours that they work in any 2-week period. For the next grouping of sick pay recipients, that would be those that are either caring for someone who's under an isolation order, caring for a child whose school has closed, or someone who's subject to quote-unquote other medical symptoms as defined by the Health and Human Services Department. It's yet to be defined, actually. But for those bucket of employees, they're paid at the lower of 2/3 of their regular rate of pay, or $200 a day. So they're paid at a lower amount. So that's the sick pay component of the FFCRA. As mentioned, there's also an expansion of the Family Medical Leave Act, which compels employers to pay for an additional 10 weeks, above and beyond the sick pay of 2 weeks that we just discussed. The expanded Family Medical Leave Emergency Act provisions apply for those employees who are either caring for a family member who is sick or caring for a child whose school is closed or whose child care center is closed. Again, similar to the second bucket of our sick pay, those individuals are paid at the lower of 2/3 of their average wages, or $200 per day. So when all is said and done, the employers are looking at this thinking, well, all of a sudden I've got to pay a ton of sick time and Family Medical Leave Act time that I was not otherwise obligated to pay before this act came online. However, here's the mitigating factor. What the government did said, the government said that they will foot the bill for these wages. Now, how that's going to happen is kind of interesting. As you pay, for example, sick time, you will receive a very quick reimbursement of that sick time pay. So by way of example, if you pay out $5,000 worth of sick time wages and you normally deposit on a weekly basis $20,000 of payroll taxes, what will happen is you'll pay the sick time of $5,000 and then you'll take a corresponding deduction in the amount of the payroll taxes that you would otherwise be compelled to remit. So in our example, you'd be remitting $15,000 of payroll taxes to the government instead of $20,000. In the event that your sick time or family medical leave payroll time exceeds the amount of payroll taxes that you would otherwise be depositing with the government, there's a mechanism by which you can get a quick, rapid cash refund from the government to make up the difference. You get that by filing Form 7200 with the government. So at the end of the day, it turns out that these additional burdens that are placed upon you, the employer, will be quickly reimbursed to you by the government. But what you really need to do is to have an open chain of communication with your payroll service provider, who's going to need to track sick time and is obviously going to be the one coordinating the reduction in payroll taxes that you will be remitting. So that's the long and the short of the FFCRA as it pertains to staffing companies. With that, now let's move on to the CARES Act, and Mike will take that.
Good afternoon, everyone. So I will be going over two of the SBA products that have been introduced to help business owners, along with some of the other provisions that may be beneficial for some of the business owners on this call. First product that came out by the SBA was the EIDL loan product, which is an economic injury disaster loan. This was came out with the first round of relief, and this is more of a traditional SBA loan. The key components is you need collateral, you have to personally guarantee it, and this actually will be completed through the SBA portal. It requires you to fill out probably a 15 to 16 page application where you do have to supply tax returns, you have to supply personal financial information, and in turn, the SBA will process that information, reach out to the applicant, and will determine what your borrowing capacity is. So at no point do you actually make a dollar amount request. The SBA will work with you to determine what that amount is. The key component of this is a loan. It's a 10-year repayment period. The interest rate is 3.75. So that is an option. The second product that came out that most likely has received the most attention is the Paycheck Protection Program. What this allows business owners to do is have access to borrowings from the SBA based on a formula, and if used for allowable expenses, the SBA will forgive the loan. So the loan is based on the average monthly payroll. So BJ, Mike, and myself have probably spent the last week and a half deciphering the bill along with follow-up remarks from the Treasury, and there's been a lot of confusion on how do you determine the average monthly salary, what incorporates those costs, what can be included and what cannot be included. So in the last week, the dynamics have changed on what is includable and not includable. So what's important is the formula begins with the average gross salaries for a time period. The SBA has allowed business owners to look at 2 time periods. You can look at the calendar year 2019, or you can use the fiscal period ended 2020. The big difference in why you may potentially want to use a fiscal year 2020, an example is a staffing client of ours had a tremendous uptick in placements in November, December, January, and February. So it made sense for us to use a fiscal year measurement period because it did provide larger average monthly salaries. Included in the calculation is you start with the gross salaries paid, and we can add to that number several things. The first amount you can add is the cost of employer health provided insurance. So again, that's the cost to the employer. So basically you take your health insurance, less the portion that the employees are paying, and then that net cost can be added to that average monthly salary. In addition to that, you can add retirement benefits. So for example, if your company has a 3% employee match, that also can get added towards the monthly average payroll amount. In addition to that, you can add the state and local taxes that incurred by the company. So the easiest example is the state unemployment insurance, which for some of our light industrial clients can be fairly substantial. You can include the net cost. Again, it's the cost to the employer less any withholdings. So all those components you will compile for the calendar year 2019 or the fiscal period 2020 to arrive at your total payroll costs for the year. From there, you'll divide it by 12 to arrive at your average monthly cost. There is one more point you have to take into consideration when determining your average monthly salaries. There is an adjustment for anyone who made more than $100,000. So for example, if your total payroll is $1 million for the year and one individual made $200,000, you would have to reduce that $1 million by the amount that that employee received in excess of $100,000. So there'd be a $100,000 reduction. So instead of $1 million of payroll, you would have $900,000. So that adjustment has to be made for every employee that made more than $100,000. Another issue that arose a week ago was, with that limitation, are you limited to $100,000 per employee for salaries, health insurance, and retirement benefits? And the Treasury issued guidance that the correct formula is it's a $100,000 salary cap, and you can add the health insurance, retirement benefits, and state and local tax to that $100,000. So that's an important feature that did change from a week ago. One of the big problems is one of the largest payroll companies last week came out with their interpretation of the bill, which was more of a net payroll calculation. So the AICPA and the Treasury did come out to correct that and provide us the correct language, which it is based on gross wages. So once you arrive at your average monthly salary, it's a 2.5 multiple, and that will determine what your forgivable loan could be. Now, what's important for everyone to understand is the SBA has made it very clear what you can use these proceeds for. So it's payroll, rent, utilities, and interest on certain mortgage debt. So for most of our staffing clients, the reality is you can use it for payroll, rent, and utilities. The SBA is willing to finance 2 months of your payroll. And the reason why the calculation is 2.5 times your payroll is that 2.5 times multiple is what provides businesses the excess money to pay rent and utilities. What's important is, again, when you're completing the PPP application, there is a bunch of certifications that you have to sign off on. And one of the certifications is that the money will be used for the intended costs. And they did put a little bite into the language where if the money is not used for those costs, that the SBA can come back and come after the business owners. And they even added some fraud language just to scare business owners into using the loan for those allowable costs. What a lot of the questions we're getting is because of the decline in business, many of our staffing firms, some are as 20% to 50% below where they were as of February. So there's two measurement dates with this loan to determine the forgiveness. One of them is if there's a greater than 25% decrease in the wages paid, there could be a reduction of the forgivable loan. And there's a head count calculation where if the head count falls from February 15th, a portion of the loan may not be forgiven. So it's important to understand that a portion of this loan may not be forgiven if you do not meet those requirements. So common sense suggestions we're making to our staffing clients is when the loan proceeds are received, we put it in a separate account used to fund payroll, rent, and utilities. If all the money is not used because of that drop in business, the suggestion is you return that portion of the money that has not been used, and then we will have to apply the calculations after June 30th to determine if the loan is 100% forgiven. I will tell everyone this past week, our clients have applied with dozens of banks. It has been quite a mess. There's no consistency among the banks in processes or documents required. The strongest suggestion I can make to everyone is you should be reaching out to your bank and getting from them in advance what the requirements are that they have, what documents you will need to provide. Most banks are using an online portal. Bank of America, Chase, for example, are all online where you can upload those requested documents. Some banks are still not online, Wells Fargo being the biggest example. They've accepted online pre-applications, which is essentially putting your name in line that you are interested in this product. We do have clients who have received loan proceeds, so some banks are moving faster than others. One important factor that came up in the last week relates to the eligibility of staffing businesses. The guidelines last week were pretty clear that those employers that had greater than 500 employees would be excluded from this Paycheck protection program. New guidance came out that is allowing business owners to use an alternative size method to determine if you are eligible for this loan. And that size standard is if your tangible net worth of the business is not more than $15 million, or the average net income after federal income taxes for the prior 2 years was less than $5 million, you will be entitled for this Paycheck protection program. So if you are greater than 500 employees, we certainly suggest you should be speaking to your professionals to see if you do qualify under this alternative method. We as a firm have assisted many of our staffing clients that are in excess of 500 employees to fill out this loan and move forward with it. We've spoken to several banks who on the surface agree with this calculation. So we'll be waiting for those clients to get their first funding. So the PPP by far has been the most talked about program. We do suggest that most of the business owners apply for this program, but please understand there is a caveat that a portion of your loan may not be forgivable if you do not meet the head count differential calculation or the reduction in salaries. So that'll run through PPP. The bill also had some other additional changes that may be beneficial for business owners. One of them was a deferral of the FICA tax, the employer portion, So essentially, a business owner can defer 6.2% of their payroll taxes for the next 6 months, actually through December 31st. This we view as more of a interest-free loan. So every week that payroll, FICA payroll tax portion for the employer can be deferred. It'll be accumulated essentially as a loan. You can do that, elect to do that through December 31st. The repayment terms are you owe half of that in December of 2021, and the other half you will owe December of 2022. So something some business owners may want to take advantage of, but again, that has to be repaid. There is no forgiveness on the FICA taxes. Some of the other ones I'll quickly go through is there is a refundable employee retention credit. This provision provides a refundable payroll tax credit for 50% of the wages for those employees that have stayed on payroll while the business has been partially or fully suspended due to the COVID-19 shutdown orders. In order to qualify for that, you do have to meet certain criteria. One of them is your gross receipts have to decline by 50% or more when compared to the same period last year. So this may be an option for some business owners. So if you stayed open during the shutdown and you had a significant reduction of revenues, this refundable employee retention credit may be an option. Some of the other ones I'll quickly go through. There's a modification for net operating losses. In 2018, the Tax Cuts and Jobs Act changed the rules for carryback losses. Under the Tax Cuts and Jobs Act, you can only offset 80% of your income with losses, and you can no longer carry back those losses. Under the CARES Act, they've changed that where you can now carry back your 2018, 19, and 20 losses for up to 5 years. So that may be a tool for any business owners that have had losses in 18 to carry that back and free up some taxes. Some of the other ones, not as significant, but may be helpful. There's a modification on charitable contributions. They're allowing a $300 cash contribution above the line. Since a lot of taxpayers under the new law are no longer able to itemize their deductions, they're allowing taxpayers to take a $300 deduction. In addition to that, there's modifications on the losses related to businesses. The CARES Act in 2018 limited the amount of losses you can offset your income with. It was $500,000 for a married couple. So beginning last year, if you had $1 million loss, the most that you can use to offset other income was $500,000. So that no longer is in play. So again, maybe something for some of you to look at in 2018. There's modifications on the limitation of business interest. Starting in 2018, there was a limitation on the business interest expense of up to 30% of your business income. That has been increased now to 50% of the income. And finally, there were some amendments on qualified improvement property. So if you performed any leasehold improvements in your facility in prior years, it was considered 39-year property. This, under the CARES Act, has moved it down to 15-year property, which means you can fully depreciate any leasehold improvements. So with that, I'll hand it back to Michael.
Thank you so much, Mike, and a great summary. And one thing that we wanted to briefly touch on, although we don't have a slide on this, but this just came out, and so the Federal Reserve announced new facilities, to kind of support, the lending, market already out there, and this is essentially, what's referred to as the Main Street loans, and so some of the highlights of this is essentially this is aimed at companies with less than 2.5 billion, that's with a B, in revenue. and less than 10,000 employees. We're not sure whether, the 10,000 number is W-2s or full-time equivalents. I'm assuming it's full-time equivalents just because of, that's generally the way it has been. These are going to be, these Main Street loans are essentially going to be 4-year term loans with a rate around 1.5%. They're going to be with a minimum $1 million loan to a maximum of $25 million. And the way you calculate it is you take 4 times your 2019 EBITDA. So what that means for smaller businesses is that if you don't reach that $1 million threshold, you might not be eligible for this loan. Again, I think this is more to support, the mid-sized businesses. But, and you cannot use this to pay off other loans or principal. But what it seems like is that this can be taken in addition to the Paycheck Protection Program, which Mike talked about earlier. And again, this just came out, so just like everything else, guidance and implementation is going to, follow. But certainly the information is starting to come out. So another opportunity for some cheap capital is out there in addition to what we've talked about already. So with that, I'm going to turn it over to BJ. And then, this is, again, we wanted to talk about some other issues, non-legislative, non-lending issues that we've come across and that we've talked about with our clients. So BJ is going to talk about other staffing specific issues.
Yeah, thanks, Mike. And by the way, there's a lot of good stuff in that CARES Act, but I think we want to be sure that if someone's taking advantage of the Paycheck Protection Plan, the SBA 7A loan, that they are precluded from participating in the the employer payroll tax deferral and the employer retention credit, refundable credit. So it's one or the other. So just bear in mind that is a requirement for those that are in the SBA loan program. With that, moving forward, this is going to be a rapid-fire sort of odds and ends bullet point session here in no particular order. Things we're coming across in the staffing industry that may be of merit or use to you, and I'll just jump right in. So for those, especially those in the light industrial space, drug testing. You may have difficulty getting the required drug testings done for your contract workforce, given the issues surrounding medical labs right now and their obvious focus on testing coronavirus. Therefore, you may have a problem qualifying your contract workforce for your clients. Ask your client for a waiver from that obligation. That may go a long way to facilitating your involvement and satisfaction of their client requirements. Project cancellations. So those in the IT space may be seeing some degree of project cancellations from their clients. If you get word of a contract cancellation from your client, maybe you want to reach out to them to see if you can offer some haircuts on margin or pricing concessions or payment concessions just to keep your own contract workforce busy during this uncertain time. M&A, mergers and acquisitions. So coming out of this crisis, there may be a real opportunity for staffing firms who have strong balance sheets to emerge and pick up smaller, less financially secure, financially stable staffing firms for what amounts to fire sale prices. There's a lot of confidence right now about a rebound in the third quarter and fourth quarter of 2020, and it may present a great opportunity for strong staffing firms to pick up and to grow and pick up some weaker firms moving forward. General opportunities. For those staffing firms that are in highly impacted verticals, so think hospitality, perhaps janitorial, see if you can reach out to your peer staffing firms who may currently have an overwhelming demand. As Mike mentioned earlier, certain manufacturers are going gangbusters right now. Those in warehousing and logistics can be right now really having a hard time finding staff. So if you're in an impacted vertical, look to see whether you can team up with other staffing firms to keep your labor pool busy. As an aside, one thing that I've seen here in Pennsylvania, I have certain clients, non-staffing clients, that were initially closed and shuttered because of the government orders to shut down. So they laid off their workforce and then made application to reopen as an essential business, and some of them were successful. The problem was, as they received permission to reopen, their workforce, those laborers that they were using, were starting to receive unemployment. And under the expanded unemployment benefits that have come online, some workers are making more money on unemployment than they were making working. So that's presented a problem in trying to attract the workforce back into a working situation. For a staffing firm, that could present an opportunity to fill that labor need. So keep that in mind for essential businesses. Maybe there's a chance to offer your labor to fill that gap. Rent. Mike mentioned this earlier. So in many states, there's been legislation that has essentially prohibited landlords from starting and commencing eviction processes. So one might think, as a tenant, this is a great time in terms of having leverage over your landlord and perhaps thinking that you're not going to pay the rent because there's nothing the landlord can do. Well, keep in mind that at some point we're going to come out of this crisis, and if you haven't been paying your landlord, you're going to be in a real contentious relationship at that point in time with the landlord, and there may be penalty charges, interest charges, and eviction processes that commence again. So our advice is to view this as more of a carrot approach than a stick approach. It's a good time to approach the landlord to see if you can get rent concessions, rent deferrals. Mike mentioned perhaps exploring whether you can use your security deposit to satisfy a month's worth of rent. It's a good time to explore those options. You do have leverage, but keep in mind that that won't last forever, and there could be repercussions if you go too far. This next section, I'm going to say this twice. I am not an attorney. But there are several points I want to go over that you should consider exploring with your in-house counsel or outside counsel that may merit your attention. For those who have contractors in the United States on H-1 visas, remember, typically H-1 visa holders cannot work from home and they can't be easily laid off. So if you're in that situation and you have H-1 visa holders, talk to your employment attorney about that. There may be some creative ways that you can sidestep some of the compliance issues there. For those who have contractors working from their homes for clients right now, you may want to think about whether you need some sort of indemnification from your client in terms of some of the issues that can arise when your contractors are working from home. For instance, if there's IT breaches or equipment damage or computers that go missing when they are taken out of the workplace, those could be liabilities for the staffing firm. So talk to your attorney and talk to your clients about seeking indemnification. Interesting one that's percolating right now is the notion of business interruption insurance. Typically, business interruption insurance contain carve-outs for viruses and pandemics so that you can't make a claim for business interruption when business interruption is the result of a virus or a pandemic. However, check in with your insurance broker. There is legislation moving its way through several states that may ultimately compel insurance companies to satisfy and honor business interruption even in the excluded areas of virus and pandemic. So keep your eye on that and reach out to your insurance broker. Force majeure. Force majeure is language typically contained in contracts, and it's a mechanism by which you may be able to extricate yourself from an undesirable contract. Force majeure is essentially unexpected or unforeseeable circumstances that may allow for a participant in a contract to escape from that contract. So if there are contracts you're looking to get out of, have your attorney take a look at those force majeure clauses within them. For those that are contemplating mass layoffs, Provisions vary by state, but you may need to comply with WARN Act provisions. WARN Act. WARN Act essentially compel you to provide advance notice to your workforce before they are let go, and at times you may be compelled to provide outsourcing help to those workers who are being cut loose. So again, those provisions vary state by state, but if there's going to be a mass layoff, check in with your attorney. I talked earlier about sick leave and the expansion of the Family Medical Leave Act. The question comes back is, as we mentioned, ultimately the government is footing the bill for that. There may come a time that the IRS or the Department of Labor comes back to you and says, well, prove to me that these employees who you've paid sick time to were really sick. Because the government shelled out all this money, and we want to make sure that we were, paying for the proper circumstances, and not for, those that are ineligible for the sick pay. So, as a best practice, we're advising that for those employees who are actually sick, probably makes sense for you to get a note from a doctor for your records, and it certainly makes sense to retain payroll records so you can substantiate how you determine the amount of the sick pay. Finally, the last point I want to make is with respect to non-compete enforceability. If you're letting go your sales staff and you're getting out of particular geographies or business lines, it's going to be hard for you to try to enforce a non-compete on that salesperson as they try and move on with their life. So you may find that your provisions that you thought were effective within non-competes may be non-effective if you've let and unenforceable if you've let that salesperson go, not to mention the fact that if you're laying off people and trying to enforce a non-compete, you may be viewed from your workforce as a jerk, and that may have negative repercussions for your work environment. So all things to think about in no order, but rapid fire. Hopefully you find some of those valid and useful. Mike, back to you.
Thank you, BJ. Thank you, Mike. And thank you all of you for joining us. We threw a lot at you, and we can't stress enough what a fluid situation this is. We will continue to absorb and disseminate the information as it comes along, and certainly we recommend that you do so. You touch base with your other professionals as this process continues. A lot of what we've talked about, especially the loan programs that Mike covered, a lot of that is phase one. And like Mike said, like for example, with the PPP, there's a forgiveness portion. There's going to be a phase two. Once you get the money, how to distribute it to maximize forgiveness. Any loan you get, there's going to be a cash forecast on how to best distribute, the money that you have. So again, there's more to come. This process is nowhere near over, and so hopefully you guys stay tuned, and certainly we will do our best to keep getting the information out there. So once again, thank you, everybody. Hopefully stay safe. Wish everybody the best, and until next time.